Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Dory Wiley, president and CEO of Commerce Street Capital, to discuss inflation rates and where the opportunities are in the banking sector. Dory, it's great to meet with you. Welcome to Trade Talks.
Thanks for having me today.
And Dory, let's start with the macro backdrop. The Fed continues to keep rates near zero and signaling no rate hikes through 2023. What data is the Fed looking at, and what do you think is its intent regarding inflation?
Well, the Fed is probably watching, number one, the employment rate. They are really trying to get to a full employment number like we had before, and they are willing to do so at the expense of or at the risk of higher inflation numbers, which we're starting to see. They have signaled that there's no intention of raising rates this year or even next year or maybe even the year after. So I don't know how they can see that far out, to be honest with you, especially with forecasts of GDP anywhere between 5 and 9%. So we will just have to see how that works. But they're still using the tool of buying $150 million or $120 million a month in bonds to deal with the demand side on the bonds. But I think they've shown that they're willing to pull all stops out to get the economy going again.
And the banking sector has outperformed in the face of raising rates. Do you think banks can continue to rally?
Well, banks are typically a little bit asset sensitive, and I think they get overplayed a little bit on whether rates rise or fall. People are always concerned, oh, bank margins are going to change during a rising or falling rate. And that's always overplayed. That's, for the astute bank investor, that's a great time to buy. Anytime that comes out negative and there's a hit on the stock, you buy it. And the reason why is because bank assets and liabilities reprice within a year. Never once in 35 years have I seen a news report where someone came in and went, oh, the banks all repriced their assets and liabilities and their margins okay again. Banks are very good at managing interest rate risk on their net interest margin. So I don't really see that being a problem as rates rise. You could have rates rise 300 or 400 basis points, and it actually would probably be okay with banks, just as it was in 1994. Banks went up 351 basis points in 1 year, and it was the worst bond market loss in history. And yet banks did what? Had a record earnings year. So I'm not really worried about the effect of net interest rate changes on banks too much. With the biggest issue is credit quality. Credit quality is always number one thing with banks, and banks are in pretty good shape right now, not only with credit, but with capital. They have the highest capital levels they've had in over 100 years. And banks certainly didn't cause this crisis that we had with COVID over the last year, but they did in 08. So they're much better positioned for it. It doesn't mean that there aren't risk in credit out there, particularly in real estate, office, retail areas of the like, but banks are much better positioned for it than they were before.
And Dory, the thesis behind the banks you are watching are not necessarily tied just to the rate story, but rather crypto and blockchain payment systems. So it sounds like the longer term story is tied more to fintech. Tell us more about that.
Banks are a great investment right now, and we've seen that sector rotation over the last, say 3 months, where banks have bounced off the bottom, they were oversold, and they've done really, really well. But as you're talking about, there is a developing story in the banking sector that really needs to be watched, that has a, let's call it, an icing on the cake type deal, and a real opportunity. Let's start with Silvergate. The symbol is SI. Silvergate was the first bank in the country to get crypto deposits, and they got them as transaction deposits. So full disclosure, we were a large investor in that bank, but we sold in February of 2018, and we were very happy with our investment, made 2.8 times our money, and they had just gotten into crypto deposits, and we hated to sell the bank, but we had been in for a while, and it was time to sell. That stock now would have made us well over 35 times our money. That stock trades at close to 10 times tangible book value, which is the highest of any recorded bank in history. They're pushing $3 billion in crypto deposits now, and it's a really interesting bank. And the Kathy Woods of ARK and all that, all these fintech investors have kind of discovered Silvergate. Now, let's fast forward to the next opportunity, which would be Signature Bank, SBNY in New York. That is a real commercial bank. Now, the Silvergate is more of a transactional bank, a very opportunistic bank, and it does have some commercial business, but nothing like Signature. Signature is a $70 billion really nice prime commercial bank in New York. And it is the first bank in the country to get blockchain payment system to go get commercial deposits, which are core deposits versus just transactional deposits. It's got a nice mix, and they're up over 10 billion right now. And they use a company called Tacit, and Tacit is the first company in the country to get this blockchain payment system into the banking system. And it gives them a chance to get the jump on all the money center banks and all the fintech companies that are trying to get banks. So what's Signature Bank? They only trade at 2.5 times book, which is very cheap compared to Silvergate, but it's a premium to other commercial banks, but it's justified.
All right, Dory, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.